This is chapter 36, the last chapter we're going to cover for this class. And you don't need to just start with the rest of the tools of monetary policy. And it looks first at the Federal Reserve balance sheet. And we see that assets to the Federal Reserve are securities, just like they are to a bank, just like they are to you. Securities can be an asset. Those are those government bonds, bills, notes, and U.S. savings bonds that make up the federal debt, and those securities pay interest. So they are an asset to anyone who owns them. So the Federal Reserve also would have loans to commercial banks as an asset because the banks have to pay back those loans with interest. Liabilities of the Fed, reserves of commercial banks, of course, they're an asset to the bank. They're a liability to the Fed because the Fed owes them that amount. Treasury deposits are liabilities to the Fed. The U.S. government has an account at the Fed. And then the Federal Reserve notes, our dollars and bills outstanding, are a liability to the Fed because remember, the Federal Reserve is responsible for printing our money. So this is irrelevant because this changes every day. Every country has its own central bank. U.S. is the Fed, Federal Reserve. Japan has the Bank of Japan. UK has the Bank of England, and so on. And they work similar to our Federal Reserve system. So let's look at the rest of the tools of monetary policy. Open market operations is the most important one. We've spent the last chapter covering the reserve ratio, which is the percentage set by the Fed that commercial banks have to hold those reserves against checkable deposits. So we've covered that. And today we're going to look at the other three tools of monetary policy. Open market operations being the most important one, because what that involves is the buying and or selling of government securities, or those bonds, T-bills, T-notes, and U.S. savings bonds. So the Federal Reserve, if you remember from the chapter where we looked at who owns the debt, basically, or who owns the securities, the Federal Reserve owns some and banks own some. And then, of course, individuals and foreigners own about a third and so on. So this is a tool, though, of open market operations is a tool of the Fed. It's used to influence the money supply. That bullet point is very important. It's the main function of open market operations. So let's look what happens when the Fed buys or sells securities. This first slide shows what happens when the Fed buys bonds or securities from commercial banks. Remember, there are thousands of commercial banks out there. They're all members of the Fed. So securities are an asset. So if the Fed buys securities from commercial banks, what happens is those securities are sold to the Fed by the banks, and the Fed basically creates money out of thin air, and those reserves go to the banks. So if the Fed buys $1,000 bond from a bank, new reserves are now $1,000. The Fed just created new money. The securities went to the Fed, and the Fed just increased the bank's reserves magically by $1,000. So the total increase in the money supply would, if the reserve ratio is 20%, would be 1 over 0.2 or 5. 5 times 1,000 equals $5,000 total possible increase in the money supply. We know it's probably going to be less than that because there is always some cash leakage and excess reserves. But when the Fed buys that $1,000 bond from the public or from a bank, and it's deposited in a bank, it's new reserves. If the reserve ratio is 20%, the bank has to hold $200, can safely lend $800. So total increase in the money supply would be 8 times the 5 or 4,000 that the banking, 800 times 5, the banking system could lend 4,000, but the initial checkable deposit was 1,000 because it's new money from the Fed. So we can start to see the